Okay, now let's look at this particular question. The normal production capacity of AG's manufacturing plant is 300,000 units per month. The fixed production overheads per month are 75 million. Due to the pandemic, the actual production in March 2020 was limited to 200,000 units. Required. Advise the management of AG on the accounting treatment for the above matter before. Okay. Now, as I discussed in the session, inventory session, I explained you the fixed production overheads should be allocated based on the normal capacity. Okay. Now, according to this question, what is the normal capacity? According to this, give me a minute. Yeah, the normal capacity is 300,000. So here, the normal capacity here the normal production capacity is 300,000 units per month. Okay, so how much is the fixed production overhead cost per month? Which is 75 million. Okay, so therefore, the fixed production overhead should be allocated. What is the fixed production overhead? Fixed production overhead absorption rate. The absorption rate will be 75 million divided by 30,000 units. Okay, so that will be 250 rupees per unit. So this is the absorption rate. Now, the actual production during the pandemic period was 200,000 units. Okay, so in a situation like this, how do you allocate? Now, I will just go back to the standard. I'll share the standard. I will share the standard, the extract from the standard. Okay, now we'll just go through the standard. If you go to cost of conversion, okay, point number 13, you can see the allocation of fixed production overheads to the cost of conversion is based on the normal capacity. So this is what I explained, the normal capacity of production facilities. Okay, the normal capacity is the production expected to be achieved on average over number of periods or season under normal circumstances, taking into account the loss of capacity resulting from planned maintenance. The actual level of production may be used if it approximates the normal capacity. Okay, so if the actual level of production is production approximates the normal capacity, then you can use the actual production. Otherwise, the amount of fixed overhead allocated to each unit of production is not increased as a consequence of low production or idle plant. Okay, so what we have to do when there is a low production, okay, the allocated cost should not be increased. Okay, so which means I'll go back to the presentation. So actual production is 200,000 units. Okay, so as I told you, the normal production capacity is 300,000 units per month, and the fixed production overhead cost is 75 million. So therefore, our fixed production absorption rate was how much? 75 million rupees divided by 300,000 units. So which is 250 per unit. Okay. So now standard says when there is a low production, as a consequence of low production, okay, you should not increase the cost. So which means you need to value this 200,000 units at the rate of this 250. Okay, so how much is that? That will be 50 million, right? This will be 50 million. Okay, so the amount of fixed overhead cost allocated to each unit of production is not increased as a consequence of low production or idle plant. Okay, so then what is the difference? 75 million minus 50 million. So the difference 25 million. Okay, so 75 million is the fixed production overhead cost per month, whereas we are absorbing only 50 million. So there's a difference of 25 million. So where do you charge this amount? Where do you charge this amount? So standard says any unallocated overhead costs are recognized as an expense in the period in which they are incurred. Okay, so therefore this 25 million has to be charged as an expense to the profit and loss account. Okay, so this is when there is a low production, you can't increase the cost of absorption. It has to be based on the normal capacity. Okay, now let's take the other scenario, another scenario. Let's say the production is let's say 200 sorry 350,000 units. So which means the normal capacity is 300,000 units, okay, but actual production is 350,000 units. Okay, so in such a situation, you can't allocate 350,000 units times 250, so which is going to be 87,500,000. Okay, so you can't allocate at the rate of 250, which is based on the normal capacity, because your actual fixed overhead cost, production overhead cost, okay, is only 75 million. Okay, so therefore you can't allocate above the cost. Okay, you have not incurred this cost. Okay, the cost is 75 million. So therefore, this 350,000 should absorb only 75 million. So which means 75 million divided by 350. Okay, so that will be how much? 75 million divided by 350. So which will be, you have to absorb at the rate of 214.29 at the rate of this. Okay, so you need to allocate this 75 million at the rate of 214.29. Okay, so this is the answer for this particular question. Okay, so please remember, when there is basically the overhead fixed production overhead cost should be allocated based on the normal capacity. Okay, when there is a low production, the difference has to be charged to the profit and loss account. However, when there is a high production, in a situation like that, the cost has to be allocated based on the actual production, so that you will not increase your cost. You will not increase. You will not recognize the cost above the cost. Okay. So this is the answer for this particular question. Okay. So let me show you the extract from the standard with regard to the high production. Let me share that screen. Okay. Now here, unallocated overheads are recognized as an expense in the period in which they are incurred. In a periods of abnormally high production, the amount of fixed overhead allocated to each unit of production is decreased, so that the inventories are not measured above cost. Okay, so this is what the standard says. So therefore, please go through the question, understand how do you allocate fixed production overhead when there is a low production or high production. Okay, I hope this concept is very clear to you now, and I'll see you soon with another video on IFRS. Thanks for watching, and until then, bye for now.